Hi viewers, I am going to read recognition of the elements of financial statements. This is another chapter in conceptual framework. What is recognition? Recognition means bringing in the elements to the financial statement. You have to put in. Recognition process. The conceptual framework defines recognition as the process of capturing for inclusion in the statement of financial position or the statements of financial performance an item that meets the definition of one of the elements of financial statements. So that it will be one of the elements has to be brought in. It has to meet the definitions of conceptual framework. Put simply, recognition means including an item in the financial statement with a description in words and a number value. Recognition one element requires the recognition or derecognition of one of the more items or more elements. That means the dual impact. When you are crediting something, you have to debit something. When you are debiting expenses, you have to credit a liability or an asset. There should be a debit and there should be an equivalent credit. So it happens like that when you are recognizing an element. You have to debit if there is an expense. If you are going to recognize an expense, debit expenses, at the same time credit an asset or credit a liability. Recognizing an element. The conceptual framework requires an item to be recognized in the financial statements if the item meets the definition of an element, that is asset, liability, income, expense or equity. Whatever the definition it meets, it has to be fit in. It will be one of the 5. And recognition of the element provides users of the financial statement with information that is useful, with relevant information about the element, a faithful representation of the element. This is the conceptual framework requirement for recognizing an element. It has to meet the definition of conceptual framework and it should be relevant and faithfully represented for the financial statement to the users has to be fulfilled. Recognition is subject to cost constraint. The benefits of information provided by recognizing an element should justify the cost of recognizing that element. So there is a cost involved in obtaining the information. So that the cost should be less than the benefits. That means the benefit should be more than the cost. Then only it will be recognized. Otherwise, it need not to be recognized. Then what is derecognition? Derecognition normally occurs when the item no longer meets the definition of an element. For example, for an asset, when the control is lost, that means you sell the asset or you write off the asset. That means there is no future economic benefits from the asset. It's used and it's damaged, then it can be derecognized because it's no longer meet the definition of an asset. It loses its status as an economic resource. Then it has to be derecognized. For a liability, when there is no longer a present obligation. If there is no obligation to pay the liability, then it expires or it is not payable. It becomes not payable. There is no present obligation. Then the liability loses its status. You can derecognize the liability. Or if you pay the liability and finish that off, no longer there is a liability, then it will be derecognized. Then we come to measurement. This is another portion which is very important in conceptual framework. The conceptual framework specifically refers to the two measurement bases. Basically, they are mentioning historical cost and current value. Historical cost is the amount that you pay when you purchase an asset or expense when you are spending it. You have the evidence and it's finished. That is due to the past transaction. It is the historical cost. It outlines the information provided by both but stresses that the choice between them depends on what information the primary users of the financial statement require. So you can select either of these, historic cost or current value, but it depends. Sometimes the users require or users prefer current value more than the historic cost in certain cases. In that case, you have to select the current value. So we see some detail about historical cost. Historical cost. Historical cost for an asset is the cost that was incurred when the asset was acquired or created, and for a liability, it is the value of the consideration received when the liability was incurred. When you borrow the money, whatever the amount that you have received is a historical cost. When you are purchasing an asset, what are the costs that you have incurred is a historical cost. And you can verify this through vouchers because you have actually paid it. Historical cost accounting is the traditional form of accounting, modified in some instances by revaluation of certain assets. In some cases, we revalue the assets as per the accounting standard, but otherwise, the historical cost of the assets are stated in the balance sheet or statement of financial position. Advantages of the historical cost basis for measurement. Amounts used are objective, as it is more difficult to manipulate cost-based figures. You can't manipulate it because it is for sure you have paid it. You have a concrete evidence for that. Amounts are reliable. They can always be verified. They exist on invoices and documents. So you have the invoices, documents, and you can prove it, and it is always reliable. The statement of financial position and statement of cash flows figures are consistent with each other. Statement of financial position shows the historical cost, and the cash flows are prepared by the historical cost. We are not taking any revaluation for the cash flows. Actual cash received and spent have been taken. So these two will be inconsistent. There is less possibility for manipulation by using creative accounting in asset valuation. You can't put any amount for the asset valuation and thereby increasing the reserve or the profit component. You can't do any creative accounting because the possibilities are very low and manipulation is not possible with historical cost accounting. Cost is a measure that is readily understood and it is simple to understand. There is no complications. It's simple to understand. But there are limitations of the historical cost basis for measurement. Overstatement of profit. They always complain about overstatement of profit because the income is current. Is under the conditions of inflation. Every day the prices goes up. So the expenses incurred are historic, whereas the current income is with the current cost. So it is not matching. That is the complaint. And you are overstating the profit because lowering the expenses, which is historic. It shows current revenues less out-of-date costs. During periods where price inflation is low, profit overstatement will be marginal. If there is low price inflation, then there is marginal overstatement. But if the price inflation is high, the disadvantages of historical cost accounting become most apparent in periods of inflation. Out-of-date asset values. Historic cost asset rates based on their historical values. For example, you have bought a building 25 years ago for 1 million. Now it will be worth several millions, 20 million and 50 million. So it is not matching. It is based on the historical value. So you can't take any decisions with the historical cost. You need the current cost or the fair values as at present. Out-of-date asset values. Return on asset capital employed is distorted by both A and B because when you are having historical cost assets basis, you show more return. Whereas with the current values, the return is less. Holding gains, losses. That is the fact that something is worth more, cost more over time simply due to price rises. Holding gains or losses. When you are holding the inventories, for example, if you are selling it after 5 or 6 months, the prices would have inflated. So you may gain something, or at the same time you can lose something because of the obsolescence. Are not measured separately from the operating results. We are not going to separately measure these holding gains or loss due to inflation because we are using the historical cost accounting. Historical cost accounting, that is the HCA, does not measure any gain or loss on monetary items arising from the impact of inflation. That is the fact that savers lose because the purchasing power of their savings is eroded, while borrowing gain because they still owe the same nominal amount while earnings have risen due to inflation. This is very simple. If you are saving, you might save 1 lakh and now the 1 lakh last year and this year the value would have gone down because the purchasing power has gone down because of the price increase. It happens. But at the same time, if you borrow, you improve on the purchasing power because we are going to return the same amount this year where the inflation is high. Current value. What is the current value? Current value of accounting attempts to address some of the problem of HCA, that is the historical cost accounting, by using information updated to reflect conditions at the measurement date. Current value measurement basis includes, there are 3 types. One is the fair value, that is the market value at the present. Value in use for assets or fulfillment value for liabilities. Value in use means the cash flows that are expected over the lifetime of the asset discounted today. And the fulfillment value or liabilities is the present value of liability after 5 years. If you have to pay, what is the present value today? That will be the fulfillment value for liabilities. Current cost, that is the cost today. Fair value, the price that would be received to sell an asset or pay to transfer a liability is in an orderly transaction between market participants at the measurement date. This is the definition given by IFRS 13 for fair value. This is an exit price. That means at the time of selling, what is the value that you can receive for the asset. Fair value is measured in accordance with IFRS 13 fair value measurement. IFRS 13 is prepared this standard because you can use a standardized form of fair value measurement in each case wherever you are using the fair value. Fair value is most commonly calculated by taking the open market value. Where there is no active market for the asset or liability, the following should be used as the basis. That is, estimates of future cash flows, time value of money, discounting the future cash flows. So you can estimate the future cash flows and discount it and obtain an estimated fair value. Value in use and fulfillment value. Value in use, the present value of cash flows or other economic benefits that an entity expects to derive from the use of an asset and from its ultimate disposal. So the cash flow from the use of an asset, what you are getting, and the ultimate disposal, what you are getting, the present value of the cash flows. Value in use cannot be directly observed. It looks at the likely future value of the entity of using the asset. Value in use considered entity-specific factors, whereas fair value is market-specific. The meaning is, value in use is entity-specific. This is specific to that particular entity for that particular asset. But the fair value, it's common. It is in the market. What is the similar asset? Fulfillment value, the present value of the cash or other economic resources that an entity expects to be obliged to transfer as it fulfills a liability. For example, if you are taking a lease, the lease payments over a 5-year term or 6-year term, the present value of the lease term will be the fulfillment value. Fulfillment value is based on the future cash flows an entity expects to incur to fulfill the liability. Like value in use for an asset, fulfillment value cannot be directly observed and is entity specific. It is entity specific, not a market specific thing. Then we see the current cost. Current cost and asset. What is the difference between the current cost and the fair value? Fair value is the market specific thing. Current cost is for an asset if you have an equivalent asset in the market and what is the price that you are going to pay, and you can deduct the depreciation whatever the period that you have used your asset. That is the replacement cost or the current cost. The current cost of an asset is the cost of an equivalent asset of the measurement date comprising the consideration that would be paid at the measurement date plus the transaction cost that would be incurred on that date for a specific asset. Current cost of a liability. The current cost of a liability is the consideration that would be received for an equivalent liability at the measurement date minus the transaction cost. So what is the net amount that you are going to pay that would be incurred as at that date? That is for the similar asset and the similar liability. That is the current cost. Current cost differs from historical cost as current cost assesses the price to purchase at the reporting date rather than the date the asset was acquired or liability assumed. The date may differ. Where the current cost cannot be obtained from the information in the market, then the entity can adjust for condition and age to buy a similar model. You may have purchased the asset 5 years ago. Now you have used for 5 years, you are depreciated and the asset will be in one condition, and how much you can use it in the future, that type of asset whether you can purchase in the market, a similar asset. Or otherwise, what normally they do is they assess the price, the current model in the market and depreciate it to ascertain the depreciated replacement cost. That is, in practice, it's being done. Advantages of using current value. Assets and liabilities are measured after management has considered the expected benefits from their future use or cash flows incurred in their fulfillment. Current value is therefore a useful guide for management is deciding whether to hold or sell assets and when it settle liabilities. The current value give you more information to make a decision. That is the advantage of using a current value. It is relevant to the needs of the information of the users in assessing the stability of the business entity, assessing the vulnerability of the business, example to a takeover, or the liquidity of the business, evaluating the performance of management in maintaining the increasing the business substance, judging future prospects. Usually when you know the current value, you can assess all the liquidity position and you can see what is the stability of the business entity because you know currently what is the assets are worth. Limitations of using current value. There are limitations also when you are using the current value. The discount factor used to calculate the present value of future cash flows requires subjective judgment. When you are estimating the cash flow, it is all a subjective judgment by the management. It can be right or it can go wrong. Also, the expected benefits from cash flows from the assets or amounts required to fulfill obligations will be based on management best estimates and judgment. So all these future predictions are the best estimates and judgment of the management are subject to uncertainty. There may be problem in deciding how to provide an estimate of current cost for a non-current asset which can only be purchased new, such as a bespoke or specialist piece of machinery. That is the machinery that you are using only for your purpose. It is not freely available in the market. It is not a uniform or it is not widely available in the market. It is only specific for you. Those type of assets, the current costs are difficult to assess because exactly identical asset won't be available in the market. It is a specialist piece. As the conceptual framework allows different groups of assets and liabilities to be valued on different bases, which are the most useful to users of the financial statement. That means conceptual framework is flexible about using these values, then it is easy and more useful for the users to select the value and make the decisions based on the financial statement. This can mean that some assets or liabilities will be valued at current cost, but others will be valued at value in use or fair value. As the conceptual framework allows different group of assets and liabilities to be valued on different bases, some of the assets can be valued at historical cost. Some of the assets can be used at fair value, current value, based on the user requirement. You can use it. This is all about the measurement and recognition. So we will close today for this video and meet at the next video for the next chapter, regulatory framework. Until then, bye-bye. But don't forget to subscribe this channel for you to watch more videos of this nature. So please subscribe and go on watching this